Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum. Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what we saw overnight. Global stocks hitting an intraday record on Monday with investor sentiment boosted by progress in US trade negotiations. However, European equity markets did end up in the red. Wall Street, though, saw more records with the S&P 500 and Nasdaq reaching new highs, ending their best quarter in more than a year. Over the 3 months, the S&P gaining 10.5%, the Nasdaq rising almost 18%, while the Dow climbed 5%, and the small cap Russell 2000 was up around 8%. Among the Mag 7 stocks overnight, Meta and Nvidia managed to finish in the green. Shares of tech companies initially rose following Canada's move to scrap its digital services tax in a bid to jumpstart those stalled trade talks with the US. Shares of Oracle rose after signing a cloud services agreement that is expected to contribute more than $30 billion to annual revenue beginning in fiscal year 28. Shares of the big US banks rose after most cleared the Federal Reserve's annual stress test, paving the way for billions in stock buybacks and dividends. Hewlett-Packard shares surged after the Department of Justice settled an antitrust lawsuit against its $14 billion takeover of Juniper Networks. First Solar also jumping. Well, US Treasury Secretary Scott Bessent has warned that countries could still face sharply higher tariffs come the July 9th trade negotiation deadline, saying we have countries that are negotiating in good faith, but they should be aware that if we can't get across the line because they are being recalcitrant, then we could spring back to the April 2 levels. Well, President Trump, meanwhile, has threatened to impose a fresh tariff level on Japan, complaining that it's unwilling to accept US rice exports. Atlanta Fed President Raphael Bostic has warned that the impact of President Trump's trade tariffs are yet to be felt, saying, I think there is actually more pricing to come. And it's more a question of time, of when and not if. And President Trump has resumed his criticism of the Fed and Chair Jerome Powell, posting on social media that you should lower the rate by a lot. Hundreds of billions being lost. We should be paying 1% interest or better. Well, US Senate Republicans are attempting to pass President Trump's sweeping tax cut and spending bill, which would extend his 2017 tax cuts while cutting other taxes and boosting spending on the military and border security. Trump wants the bill passed before the July 4th Independence Day holiday. US Treasury yields have eased the 2-year down to around 3.7%, the 10-year at 4.23%. And the US dollar has fallen to a near 4-year low against the euro, amid concerns over the rising US government deficit and uncertainty surrounding trade deals. This comes on reports that the EU is open to accepting a trade agreement with the US that would apply a universal 10% tariff on many of its exports. The Aussie dollar has climbed to 65.8 US cents, and Bitcoin is trading around 107,000 US dollars. Oil prices edged lower on Monday as investors weighed easing Middle East risks and a possible OPEC Plus output increase in August. Brent futures down to $67 a barrel. Copper's down around 0.5%. Iron ore down 1% to $94 a tonne. And gold, boosted by a weaker US dollar, it's up around 1% at $3,300 an ounce. Well, for more on US markets, Steve Sosnick is Interactive Brokers Chief Strategist. He joins us again now. Steve, good to have you back on the show. As we round out the quarter, It has been remarkable, hasn't it? Given where we began in April, that sharp sell-off, the rebound has been dramatic. How would you assess what you've seen over those 3 months?
This has been among the craziest quarters I can remember, and I got to believe among anybody's memories. I try to use the analogy of a roller coaster, but it's actually was the opposite, because normally when you think about a roller coaster, you climb up and then you dip down and then you have a bit of a volatile ride. This time we did the opposite. We went down and then we shot higher and had a little bit of volatility, and then we continued that ride up to the top, and we haven't really seen that end yet. We don't know when it will end. It shows you the power of momentum, and it shows you the power of FOMO. I wrote a piece today. I called it Momo and FOMO driving the markets, but that's really how I view it. It's some combination of momentum trading and fear of missing out. Those become two very powerful motivators when working in conjunction.
Well, it's interesting, that battle between the bulls and the bears, of course, with the bears saying, look, essentially these gains are signs of investor complacency, whereas the bulls citing cooling inflation, the prospect of rate cuts, improving consumer sentiment. So the bulls remaining on top at this point.
Yeah, it's a little hot for bears to hibernate around here, but that seems to be kind of the mentality. Is the bear, there's been a big retreat, among those with bearish sentiment. We don't. There are plenty of things on the horizon that could upset the ride that we're on, but right now the market seems disinclined to think about them. The tariffs on again, off again. The market's decided that they'll get pushed back or negotiated out or something. And we saw today Canada had a tax coming in, and then it all of a sudden, so what? We'll get rid of it, and then that passed. So the feeling is the tariffs are largely behind us. The budget bill appears to be a real budget buster in many ways, but the bond market doesn't seem to care right now. I do think the bond market, at least the long end, is having its own sort of momentum-driven rally, but those tend to end right at those. We do tend to see those, rally or fade into quarter ends, and then it lasts like another week, and then they go back about their merry way. But we have seen the bond yields come off dramatically, and the curve steepening that might be feared never happened. But we do get into earnings season starting in about a week and week or two in earnest. I do think we might have outkicked the coverage a little bit. The earnings expectations are back to being very robust, but yet we saw one example that kind of sticks in my mind is the way we saw Micron react after its earnings recently, and I use that as a bellwether more than, let's say, Nike or some of the other ones that did respond well and should have. But Micron should have responded really positively. They beat on every metric and reaffirmed guidance and actually raised the guidance, and the stock sold off anyway. So I do have to wonder if some of these stocks have gotten a little ahead of themselves, and that earnings might sort of be a jolt of reality. But again, especially after being so charitable last quarter when companies were allowed to basically withdraw their guidance with impunity, we'll have to see if that can persist in the coming weeks.
And Steve, do you have concerns that this is driven by narrow leadership once again, given the outperformance of large cap tech, particularly in relation to the AI thematic, and leaving perhaps the other stocks in their wake?
Yeah, to a certain extent, yes. It is size weighted no matter what, because some of the other companies that are doing well are big financials, as you alluded to at the top of the segment. But even there, the stress tests only apply to the biggest financial stocks. So its size matters right now. And that really seems to be the key. But when you break it down, I did some numbers of the S&P 500, and then vis-a-vis the SGX and SVX, the growth and value components of it. And there was about an 8 percentage point difference. The growth stocks outperformed the SGX outperformed SPX by about 8 percentage points, and then SPX outperformed SVX by about 8 percentage points, meaning therefore that value outpaced growth by about 16 or 17 percentage points. That was huge, and it's telling you that it's really the large cap techs. And the other way that I look at that is NDX, which is the NASDAQ 100 and very heavily dominated by big cap tech, and SGX, which, as it turns out, is pretty much dominated by a similar group of companies, move almost in lockstep. So it's telling us that growth stocks are really driving it. We did see a little bit of a rebound in the mid cap, let's say, in the Russell 2000 over the past couple of weeks. It really hasn't kept up pace with the S&P as a whole. And for the year to date so far, they're flat to down. So it's really been this is why I keep coming back to the momentum theme, because it's the stocks that have the most momentum leading the way, and doing so by a wide margin.
Steve, do you have an expectation that the dollar is going to continue to weaken? And if so, what's the impact there on capital flows?
Well, I think we're seeing the impact on capital flows. I think the U.S. exceptionalism as far as stock markets go was really not the case for the last quarter and for the year to date. We've seen various other markets, whether it's the Nikkei this quarter or on a year to date basis, the Hang Seng or the DAX, outperforming the S&P 500. Euro stocks kept up. I do think that this persistent weakness in the dollar is telling us that there's capital flowing out. I think right now it's a bit more of a drip. For a little while after the tariff worries, it was a bit more of a fire hose. But I do think this has been a trend. It's from what I can gather, it's been about the worst first half of a year for the dollar in I think 50 years. I just saw that headline go by. I have not had a chance to really verify it fully, but it was from a reputable source. So depending on how you measure it, the U.S. dollar's been a headwind. Now, the good news is, from an earnings viewpoint, after I just sort of said, let's see what happens with earnings. A weaker U.S. dollar is a help for the various multinationals that dominate U.S. indices, because these companies earn revenues, loads of revenues overseas and domiciled in other currencies. So this helps the translation when those results get brought back into USD. So in the short term, it's certainly not hindering U.S. stocks. In the longer term, if this slow leak becomes a bit more of a faster flow, I do think that becomes a headwind, but we'll see it first in bonds. If we start to see bond yields tick much higher, or you start to see the yield curve steepen dramatically, which could mean that people are worried about both economic weakness and inflation, a bad combination. That would be the time that I would really start to get very nervous about the U.S. dollar flows.
Steve, we always welcome your analysis. Thanks for joining us from Interactive Brokers.
Thanks, Andrew. Great to see you. Take care.
Let's get back home. What we're likely to see when we get going in just a couple of minutes. SPI futures off marginally, so perhaps looking at a flat start on this Tuesday. Stay with us as we get across that in just a couple of minutes' time.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.